Hi, my name is Christian Waldegrave, Head of Research at Teekay Tankers, and we are restarting our monthly video series on the tanker market, beginning with our outlook for May 2022. Now, if you've been following the tanker market over the past couple of years, you'll know that 2021 was a very weak year for spot tanker rates due to the negative impact of the COVID-19 pandemic on oil demand and subsequent oil supply cuts. And that weakness persisted into the first 2 months of this year, particularly due to the Omicron variant, which hit oil demand over the winter. However, after Russia's invasion of Ukraine in late February, we saw a sharp uptick in spot tanker rates, particularly for Aframax and Suezmax, and that's due to the trade route disruption caused by Russia's invasion. So what we've seen over the past couple of months is that Europe has been importing a lot less oil from Russia, and those are all very short-haul barrels that typically went from the Black Sea and the Baltic into Europe, and instead Russia's having to send its oil further afield, particularly into Asia. And we've seen a big uptick in Russian oil moving to India, for example, on Suezmaxes, which is a much longer voyage than into Europe. And so it's boosted tanker ton miles. At the same time, Europe's had to replace its imports of Russian crude with sources from elsewhere. So what we've seen is more oil moving from the US Gulf, from West Africa, and also a little bit from the Middle East into Europe. And those are mostly trade regions that suit the mid-sized tankers, the Aframax and the Suezmax, rather than the VLCCs. You'll see that the VLCC spot rates have been a bit more subdued and lagging behind the mid-size. And that's because the Vs are a lot more dependent on the long-haul movements of crude, particularly into Asia. And with the lockdowns that we've seen recently in China, that's really impacted the VLCC market, whereas the mid-size has been able to benefit from the disruption in Russia. Product tanker rates have also been strong over the past few weeks, and that's been driven by very low refined product inventories, and then the disruption caused by Russia's invasion of Ukraine and rising demand, which have all contributed to very strong refining margins, particularly on diesel. But as we move into summer, we anticipate a lot more travel in Europe and in North America as we move out of the pandemic here. And so that's really going to boost a lot of demand for gasoline and jet fuel. So that's going to boost LR2 rates, and particularly we think we'll see a lot more long-haul product movements from the Middle East and from Asia coming into Europe to supply that diesel that's being lost from Russia. So we do expect product tanker rates and LR2 rates to stay strong in the medium term. There are some headwinds on the horizon, though. I think with Russia's invasion of Ukraine, with rising inflation, higher interest rates, global supply chain issues, these are all impacting the global economy. And if we look at the projections from the likes of the IMF, they've cut their global GDP growth forecast for this year, and oil demand forecasts have also been cut. And so that's generally negative for tankers. But I do think that in the near term, the disruption caused by Russia that I've just described, and the trade route disruption and the rerouting of cargoes will probably cause continued volatility in tanker rates for the foreseeable future. If we look a little bit further ahead, the fleet supply fundamentals look very positive for the next 2 to 3 years, probably the most positive we've seen in a couple of decades. New building prices are the highest they've been since 2009, and shipyards are full through to the second half of 2025. And that's because of a record amount of container ship and LNG carrier orders, which are soaking up all of that yard capacity. So with high prices and a lack of shipyard capacity, that's really deterring new tanker orders. And orders in Q1 of this year fell to 0.2 million deadweight, which is the lowest since Clarkson started recording data in 1996. So the tanker order book is shrinking. If we look at the order book as a percentage of the size of the existing fleet, we're down to about 6%, which is, again, the lowest since 1996. And at the same time, the existing fleet of ships is aging. And the next 2 or 3 years, we're going to see a lot of ships hitting age 20, which may face phase out. So if you take high new building prices, a lack of yard capacity, no one's really ordering new tankers, and the fleet getting older, we think that that's going to create very low tanker fleet growth over the next 2 to 3 years. And our forecast is for about 2% fleet growth this year, falling to 0 next year, and then probably negative fleet growth in 2024 and 2025, as removals are expected to outpace new deliveries into the fleet. So summing up, I think in the near term, we're going to continue to see some volatility in spot rates due to the situation in Russia, and we'll see how that unfolds more over the next few weeks and months. But looking longer term over the next 2 to 3 years, we certainly think the fleet supply fundamentals look very positive, and that should drive a much stronger tanker market as we get into 2023, 2024, and 2025. So that's our outlook for the tanker market for May 2022, and we'll speak to you again next month.